Hello. Growing numbers of Australians are interested in setting up self-managed super funds or family super funds, and increasing number of them are doing so at a younger age. In fact, in July 2013, a study released by SPA and Macquarie Bank found that 46% of those setting up self-managed super funds in the last year were under the age of 30. So is it appropriate for you? And what are the things you should be aware of? There are 6 things that we see as a potential benefit for people thinking of having their own family super fund. Firstly, control. You decide exactly what you invest in, how much to contribute and where to invest those funds, including direct property, which is of great interest to many people, particularly at the younger age of the spectrum. Secondly, security. Members of a super fund are protected from creditors compared to having the same investments outside super or in other structures. Thirdly, flexibility, both in your investment choices, but also your retirement income options are a lot more flexible and can be much more highly tailored to members of a family group within a self-managed fund compared to using a public offer or other type of super fund. Fourthly, cost efficiency can be an advantage depending on how much people in the family have in super already. You can have up to 4 members of a super fund, so typically the 2 parts of a couple and perhaps their children, although one needs to be a bit careful on involving children. Only having 4 able to join a fund can be a problem if you've got 3 or more children. But by pooling your assets together, you can actually reduce the costs and compared to holding multiple accounts with different super providers. General rule of thumb is to keep your costs under 1%. You need at least 200,000 within your super fund, as it costs around 1 to 2,000 and upwards to run a fund. Fifthly, tax efficiency. By having your own fund, you have a lot more control over both the taxable income and the expenses, which in another type of fund is all washed out and you don't have the benefit. So you pay tax on contributions, but you get deductions for the costs of running the fund, such as paying your accountant or paying for advice, paying insurance premiums. So with a self-managed fund or family super fund, your actual net tax payable can well be lower if structured correctly compared to having the same investments made into a public offer super fund. And the 6th benefit is in the estate planning area. As a family super fund, many people are interested once they get to the stage of life where they can see their own needs are cared for. They want to think of how do they pass their wealth on to the next generation without the tax office getting more than their fair share on it. A self-managed super fund allows a lot more flexibility in taking advantage of ways to legally minimize tax without having to sell assets and realize capital gains in the process. However, it's not all about benefits. There are also some disadvantages which you need to consider before deciding whether it's right for you. And the ASIC Money Smart website actually lists 5 questions which I'll cover briefly. Firstly, will you save money or will you waste it? As mentioned earlier under cost, there are flat costs for running a fund, and if you have less than 200,000, it can actually cost you more. Doesn't necessarily mean it doesn't make sense for you, but you need to be really clear why you're paying more money than you might need to. Will you actually benefit in the long run from doing that? Secondly, will I lose valuable benefits? Many people are unaware they actually have insurance within their super fund and can unknowingly roll out of their fund and then have problems getting insurance within the new fund. But with planning, that can easily be mitigated. However, there are other potential loss of benefits like the anti-detriment payment, which people with large super balances who die can get. But once again, with careful planning, with your own fund, you can actually plan to mitigate that disadvantage. Thirdly, and perhaps one of the most important ones, is will you actually outperform a super fund? Large super funds have professional investors, and you need to be very clear why it is that you will be able to add more value than perhaps a professional manager. And a key reason for many self-managed super fund investors is that they take a longer term view than the fund managers, and they're not worried about the next quarterly or monthly or yearly performance table. They're taking a long term view and are more patient. Fourthly, do you know enough? Do you know what your legal responsibilities are while you seek advice and use accountants and advisors and perhaps actuaries? Ultimately, you have responsibility as a trustee. are you prepared to learn? And finally, what if something goes wrong? There have been recent cases that made the press in some years, and super funds under APRA, which is the regulator, have some measure of protection, whereas self-managed super fund investors are on their own. So you need to be confident when you make an investment that you are not protected, and so diversification is a very important part of that. So I've run through six benefits and 5 disadvantages. If you want more help in deciding whether it's right for you, you know where to come. Thank you for watching.